potential support, which we've already identified on the daily chart. Market ran up, made a swing high, came back and retraced. Now, you can trade this with a pure understanding that's a support level, and this could be your retracement here. Okay. Now, again, that's a 4-hour basis. You could do that, and the reason why is because you're using the same underlying premise that prior to this move up, the first down candle prior to it, which is here, if price returns back to that range, as it does here, okay, and I'll drop a fib on that so you can see the mechanics behind it. Okay, you can see the 79% retracement level stops at dead to rights, boom, right there. Okay, and then price rallies up. In here, when we have this break here on a 4-hour, this is much more dynamic. When you see this take place, okay, put this in your notepad. If you see the overall pattern on a 4-hour chart break like this, and you're overall bullish still on the higher time frame daily, man, get ready, because it's going to have a dynamic price surge higher once we have a return back to the point of origin. The point of origin is what we discussed right here, and then when price moved up here, again, the first candle that's down prior to the rally up, once price rallies up away and breaks the swing high like we just discussed, right here, we have this rally up, we wait, and when price returns back to this point of origin right in here, okay, this is where they dip back into that order block, okay? So they had their orders here, they came back, they want to get an average fill around here, that 130.20, maybe 130.30 level. If you look over here, you can see that's the case. Price comes down, dips back into that order block again. Okay, they spend about a day or so in there acquiring more long positions. Okay, now what we'll do is we're going to use this swing low here up to the high here, okay, using that same range, and you can see the 79% retracement level right in here is containing the bodies of the candle, and there's only been 2 little wicks, okay, and we're talking about maybe 3 pips that it violated the 79% retracement level. So if you were using just a 10 pip stop below this low here, and I don't want to get into stop loss placement yet, but I just want to give you a little hint as to what's going on. If you're buying in here at the 79% retracement level, and we'll just be fair and say you're buying at the 70 and 70.5, at the low, here's 37 pips, and your stop to be 10 pips below that would be at 130.04. Okay, and that means you'd be risking, if you were trading just on the 4-hour basis, you'd have to have a stop of 47 pips, and that's still very close to what my average standard 30 pip stop loss is. So you can see how, by understanding this, we've already trimmed down a huge amount of the risk on a 4-hour time frame. Not to mention what we could do if we drop down to an hourly basis and or 15-minute basis, which we'll do in a few moments. But just for the moment, let's just look at this again in greater detail. Price moves down into this order block based on this candle here. You see it does not really jab down here and stab very aggressively. It just holds the 79% retracement level as we just noted earlier. So once price does this and it accumulates whatever it is that the institutional traders are trying to acquire, I don't have the insight as to what it is specifically they're trying to acquire, how much of the position they're assuming. I just understand the footprint that they leave in the marketplace. So when that takes place, okay, we know that it's most likely going to have an aggressive move up. Okay, because we had the first run up here and then a 4-hour market structure break here, and then you wait for it to come back. Where's it going to come back to? This is your point of origin right here. Okay, and it could very well easily come back into this one as well and create more or less like a double bottom. It rarely does that, and the reason why is because once it goes down, it doesn't want to usually come down much lower than that, because other institutional traders may get on board and drive much lower than that and throw off their targeted average entry price. So as they move up here, you can see, you literally can see it. There's a buying opportunity here. They acquire. Okay, it starts to move too much, so they settle down, relax, let price come back down again, dips back into this little area here. okay, they buy more of it and it rallies up. You can see there's much more aggressive buying pressure on this candle here because it took 3 4-hour candles to make this range here, and then 1 4-hour basis, boom, they took it up to here, then come back, retraced, where's it retracing to? The point of origin right here, and then all of a sudden the remaining block of trades that they want to assume for a long position was acquired here, and then they're off to the races. Now, just trading back to an old high like this, let's note that, and you can see, okay, looking for upward targets as like that, we're going to use this one first as an objective, as an example. There's 270 pips laid at your feet, and this one here, again, we're going to assume you traded at the around the sweet spot. And again, there's 240 pips. So you really, would you be willing to risk roughly 50 pips, just trading on a 4-hour basis, risk 50 pips to make 240 pips? Does that sound like a good reward to risk? I'll leave that up for you to decide. But as price moved up, you can see it easily, quite easily hit this objective and then moved on beyond that as well. So with this example here, you can see how just simply waiting for these scenarios to set up, you can trade really a good number of pairs if you're trading on a higher time frame basis like that. Because number one, think about how much time it takes to set these trades up. It takes a good bit of time. Also, it gives you an area where to anticipate and hunt these specific patterns. Okay, so it allows you the freedom to sit on your hands and wait and not feel rushed to get in there and just take a trade simply because it's something to do. So now what we're going to do is we're going to actually drill in tighter. Okay, and what I'm doing is I'm actually moving into this little pocket of price action. Okay, so this fractal here, we're going to look at in regards to a 15-minute, let's go down to a 1-hour basis and see what that does first. Okay, now you can see price rallies up out of here, and right in here you can actually see how we're actually starting to fine-tune. Here's the bearish candle, the first one right before you go to the move up. So if you bracket that out, okay, you can see that's the order block in here. Now again, it's anywhere in here specifically, okay, but what I like to see is like a Fibonacci level and or pivot level in this area to suggest where price may be going. Also, I like round numbers, and in this case the 130.40 level is really ideal, and you can see that's also roughly the same price point this swing high is. Now also remember what we talked about when we look at swing highs, we like to look at the 3-bar pattern. Okay, here's the highest candle in this pattern. The right candle to the right of it with the lower high, its open and close and high and low is important. The open, high, low, and close on the high candle, or the highest most of the 3-bar pattern on the swing high pattern, and then this high here, the open, high, low, and close as well. So when we factor those individual price levels, you can actually take that out and extend it across in terms of like a horizontal lines, and really specifically wait for price to move down to those levels on a 5-minute or 15-minute basis, and really fine-tune your entry in regards to what may be possible for trimming down the stop loss orders. So now what we're going to do is we're going to take this same price level here, okay, and I'm going to look at this small little section in price right here, and I'll make sure I'm not getting more than I want. Okay, right in here is what I'm looking for. Right there. And again, that's January 9th. And we're going to drop down to a 15-minute time frame. Okay, and now watch. We have price action, okay, in here, moving up on a very short-term basis, okay, and comes back down. See this candle here? That's your point of origin, where the rally ensues, right in here. Move that out in time. Right in here, price comes back down into it, and then runs up, okay? Same thing here. Okay, we have this rally here. Here's the candle prior to the rally up. It's bearish. And if you take that area here, you can see it enters that order block again.